Welcome to the penultimate presentation for Chapter 3. You like that word, penultimate? It means second to last. We got two more. And in this presentation, we'll take a look at the different types of stocks that are available. And what we'll find is that some companies fit neatly into a certain category, and some companies don't fit into any category, and some companies fit into more than one category. These categories are paraphrased from the book One Up on Wall Street by Peter Lynch, which you should read, and we've added and played around with a few of them. But often people think, when they think about stocks, that they're all the same. That stocks are the same. They're all crooks and stuff. Well, there's a lot of crooks, but no, this is a silly, absurd assertion, because all companies are not the same. And remember, the stocks are just representation of ownership of the businesses. Don't like that word, stocks. So let's get started on slide number 4 with types of common stocks. And the stocks we hear the most about, typically, not always though, are the blue chip stocks. Financially strong, high quality stocks with long and stable records of earnings and dividends. They're often referred to as value stocks, but we're going to see that value sometimes means different things to different people. They attract conservative investors, and we're not talking about politics here, folks. We're talking about people who, yes, do want to invest in stocks, but don't want to see them crack, fall, and dissolve into a pool of tears before their eyes. So these are the companies you've heard of, most all of them, like Exxon and Johnson & Johnson, right? The stalwarts is the word, stalwart is the word that Peter Lynch uses. And where does the term blue chip come from, by the way? Oh, it comes from over 100 years ago, when the hoi polloi, the rabble, we little folk, didn't own stocks. Gentlemen owned stocks, and gentlemen went to the gambling tables because that's what gentlemen did, and the blue chips were the most expensive chips in the casino. Not the most not the most fortunate, I should say, reference to gambling, but no, that's where the name came from. Income stocks are stocks with long and sustained records of paying higher than average dividends, and we love dividends, right? Dividends don't lie. And they too are also often referred to as value stocks. So these are typically companies that are in slow growth industries, mature industries, utilities, banks, right? Boring companies. Now, sometimes they happen to be blue chips, right? So sometimes they might fit into both categories, and that's not unusual. So if you're a conservative investor and you're interested in dividends, you will be attracted to income-oriented stocks. Remember the term equity income when we discuss mutual funds? Right. Slide number 75. Now, the growth stocks. Oh, these are the stocks that everyone talks about on the talk shows with the beautiful hosts, and they're on the cover of GQ and Vogue and Vanity Unfair. They've got beautiful teeth and wear gorgeous clothes and $200 haircuts. These are stocks that experience high rates of growth in operations and earnings. A growth rate of 15 to 20% or higher is typical, and they're often associated with high price to earnings ratio. And you might not think that 15 to 20% growth is high, but it is, folks. If you were growing at 20% in 2 years, you'd be twice as tall as you are now. Often there's no dividends at all, or a very small token amount, because why? They're reinvesting the money back into the company to grow the company. Now, the stock price should go up, but they're gonna be volatile. What's the word for volatile? Oh my goodness, I lost a lot of money. So, what are some examples? Intel, Dell, HP. Wait a minute. Are Intel, Dell, and HP still growth stocks? No, 30 years ago when the PC industry was exploding, sure, but not now. Who are the growth stocks? Right, the darlings of the media. They call them the fangs. For you don't hear that term too often. Face plant. I'm sorry, face farce book. Face. No, it's not called Meta or Meta or Muda or whatever it is. And Amazon, Apple, Netflix, Google. These were the darlings of the investment world since the global financial crisis. And all you had to do was buy these growth stocks, and some of them you may have heard of, like Shopify or Spotify or Twilio or Roblox, Stitch Fix. Well, folks, they were all going in two directions, up and way up, until 2022, when some of them did a faceplant and fell quite hard. So what's the prognosis for the growth stocks going forward? Well, they're going to be volatile, but you will hear some investors say that, oh, I only go with growth stocks. And we'll discuss betterinvesting.org somewhere along the line in our adventure this semester, this time. And they really do want you to think about just dealing with growth stocks, which, I'm not trying to poo-poo them or anything, but you have to be prepared for the volatility. Oh yeah. Now, on our first slide, we talked about blue chip and income stocks, and we said that some people call them value stocks. And then our second slide, we talked about growth stocks. And so here on slide 76, right, we're going to discuss growth versus value. And so you have to be prepared for this. The investment world loves to throw around the terms growth and value. But here's the problem. The meanings of the terms are not exact. Typically, investors often use the term growth to designate a high price to earnings stock, a stock with a high price to earnings. And they use the term value to denote a stock with a low price to earnings. And we discussed price to earnings last presentation. We're going to discuss it quite a bit because it's a very important statistic. We relate the earnings per share to the price. But when I think of the word value, I don't worry about whether it's a high PE or a low PE stock. I worry more about whether there's something worthwhile there. Is it something attractive? Is there some value that I believe this stock has? And the truth is, and the situation often occurs, that a high PE stock might be a very good value, while a low PE stock might not be such a good value. In January of 2005, Google was selling for around $200 and had a sky-high PE. I think it was in the 60s or 70s. While the old GM was selling for $34 with a very low PE and a huge dividend. Google now sells for somewhere around $5,000 split adjusted with a much lower PE. And the old GM, which went through bankruptcy, was renamed to Liquidation Motors, but then they switched it to Motors Liquidation because I guess GM didn't like the play on words, General Motors, Liquidation Motors. It last sold for 4 cents in March of 2011 and is worthless now. Which one was the better value? At the beginning of the 2010s, IBM was selling at a very low PE, paying a very healthy dividend. Amazon was paying nothing in terms of dividends and had about 60 or 70 PE. How did they do over the 2010s decade? Amazon did a whole lot better than IBM. So there you have it, folks. Watch out. You're going to hear people use the term growth and value, using growth to mean a high PE stock, value to mean a low PE stock. But when I use the term value, I think it doesn't matter the PE, is there value there? So when you get into conversation with other investors, make sure you set some ground rules. Make sure you say, how are you using the terms growth and value? Okay? Okay. All right. Slide number 77. Speculative stocks. Don't you just love the word speculative? It means gambling. These are companies with a high degree of risk. They're typically losing money or have very low earnings relative to their valuation. They offer the possibility of substantial capital gains. One of our students uses the term dark horse. More likely, though, your substantial capital losses. Biotechnology, internet, alternative fuels, marijuana. These are the kleptocurrencies. Cryptocurrencies. These are the speculative stocks now. So anybody want to buy some Robinhood stock? Well, before you do, I want you to take a look at the history of a company called what was it called? GoPro, right? GoPro. One of my students just kept yelling about how this company's going to do really, really well, and I kept looking at the company and thinking, I don't see why. What do they do? You know what this GoPro sells? They're famous for their Hero. They call them Hero, right? Hero cameras that you put on your helmet or your scuba diving. They're for athletes. They're for very athlete-oriented people. And I kept saying, well, wait a minute, it's a camera, right? If there's such a big market, why isn't Canon or Nikon or Apple or Samsung, why aren't they creating these things? Well, it turns out that once everybody who were real hardcore athletes bought them, there weren't any more to buy anymore. So the other companies realized that this market was very small, and Go Broke jumped to $80 and then down to $6. An investment operation is one upon thorough analysis promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Have you seen this definition before? I think I've showed it to you before, by Benjamin Graham, Warren Buffett's teacher. Look, I'm not saying you shouldn't buy a speculative stock. That's not. Don't get me wrong. But for every one speculative stock, right, buy some blue chip, buy some income-oriented, maybe a bona fide growth stock. Just be careful, folks, because these guys can just destroy your wealth. That's what I shouldn't tell you that I was a sucker for these biotechnology companies back a long time ago, and they all had fabulous technology, and they were going to change the world, and it just didn't work out that way. Anyway, slide number 78. It wasn't their fault, actually. It's just that it didn't work out. Slide number 78. Cyclical stocks. So these are companies that are around. No. These are companies whose earnings and overall market performance are closely linked to the general state of the economy. They follow the business cycle of advances, growth, and then declines, recession. And the poster child for cyclical stocks are automobiles. When the economy is doing really well, people are getting raises, new jobs, everybody's happy. What do people do? They run out and buy a new car. What's wrong with the old car? I don't know. I like that new car smell. It's good for your lungs. No, when the economy is doing poorly, do people go out and buy new cars? No, thank you very much. Old Bessie's doing just fine out in the driveway. And it turns out that any company that makes stuff like timber, steel, chemicals, they tend to be cyclical. They go do really well when the economy is doing well, and then they get hammered when the economy does poorly. On the other side of this coin, so to speak, are defensive stocks, not stocks that make bullets and tanks. And no, we're talking about companies that tend to hold their own. Actually, sometimes they do well when the economy starts to falter. The price does well. These are companies that remain stable during declines in the markets. They're often associated with income and value. There's that term again, stocks. So we're talking food companies, medical companies that sell drugs. I mean, you take more insulin because the economy's doing well? No. You take less insulin? No. You take your insulin like your doctor told you. Do you eat more Kellogg's Corn Flakes or General Mills Wheaties or Cheerios? No. Yeah. And then Procter and Gamble. You ever hear of them? Yeah, Procter and Gamble. They make soap and Tide and Head and Shoulders, and they make Crest toothpaste and Gillette razors and Pampers and yeah. So these are the defensive stocks, and they do well when the economy starts to falter. Well, what you'll hear when you listen to the talking heads or read or whatever is that traders are rotating out of the cyclical and growth stocks into the defensive stocks because of the recent recession. Right, some people, traders, speculators, will move into defensive stocks when the economy hits the skids. So they actually may go up while the growth stocks get hammered, cyclical stocks get hurt. So it's that's traders, that's speculators. That's not us. We're investors. We hold them for the long term. And when the recession hits, we just get on our raincoat and hunker down and maybe even buy some more shares because often there's some great bargains out there. Okay, next slide. Turnaround stocks. I tend to call these goners. These are companies that have fallen on hard times, and what you as a potential investor have to decide is there a potential for a rebound? Well, in the early 80s, 1980s, folks, Chrysler almost disappeared. I mean, the cars were so bad, vital parts were falling off as you drove them off the lot. And the company was in deep kimchi, deep trouble. A gentleman by the name of Lee Iacocca, and if you're so inclined about business successes and very successful business people, read his autobiography, read about Lee Iacocca. He's actually the gentleman who was the project manager for the Ford Mustang. Right, a car that's been in production for 60 some odd years. So this gentleman, Lee Iacocca, turned Chrysler around. The stock had gone from about 50 or so down to 3, and within a few years, it was back up into the 40s. Yeah, pretty darn good. Now, most of them don't turn around. That's why I call them goners. And the same thing happened in the 2008 and 9 global financial crisis. All three of the big three, Ford, Chrysler, GM, almost disappeared. And that's a whole other story that you can look into, how they survived. AMC, the chain of movie theaters, they got destroyed by the pandemic, and now it seems that they're going to survive. We'll see, but their stock has been used as a trading vehicle by many people, and that, to me, just no, it's a red flag. So turnaround stocks are often goners, but not always. Asset play stocks. This is where you really have to dig deep underneath the company to see, underneath the face of the company, to see where the assets are lying. These are companies that are sitting on an asset or assets that could be spun off or sold if there were ever a problem. And a perfect example, this is JCPenney's. They've been around for over 100 years. Their retail business has had a very, very difficult time the last 20, 30 years because they're fighting, the Walmarts and the Targets from below and the Nordstroms and the other boutique sellers from above. So they're really getting squeezed. And they had this very profitable insurance division. I think it's called Stonebridge or something like that. And they're the ones who, when you have a child, they send you this thing with the little beautiful baby with the chubby cheeks. and trying to sell you insurance on the baby, which is totally useless, but it makes a lot of money for them. And they were able to sell that in 2015 to keep the retail company afloat. I don't know about JCPenney's future, but I'm the worst person to ask because I absolutely hate shopping. And there's another example. Let me ask you a question. Who owns Frito-Lay? Huh? Look it up. Look it up. You'd be surprised. A very valuable asset for this large company that you know this company. I know you do, so look it up. I won't tell you. No spoiler alert today. And then penny stocks. Well, we really shouldn't discuss penny stocks in polite company, folks. They're scams, they're shams, they're bogus. They're not real companies. They're somebody's garage somewhere out there in the hinterland in one of those states that begin with the letter I, like Idaho or Iowa. And so you do not want to get involved. Now, on the website, normally we would stop in the face-to-face and start showing you some examples. But on the website is a presentation, or no, not presentation, but a bunch of examples and some commentaries about these penny stocks. Just stay away. And if you think you can beat these people at their own game, remember, when you're playing poker at the table and you don't know who the patsy is at the table, who's the patsy? Who's the fool? You are. So stay far away from these people. They have you outgunned at every corner. Just so forget about Butterfly.com and Flim Flam Incorporated. And they used to make Blue Steam, and now they're selling left-handed smoke shifters, and some of them are getting involved in marijuana, and just stay away. Slide number 80. Foreign stocks, sometimes called international stocks, overseas, right. Traditionally, it was difficult for United Staters to transact. And so what some enterprising companies on Wall Street would do, usually a bank or a trust company, is they would go to Japan or go to Europe and buy up a ton of shares, bring them to New York, and reissue them as dollar denominated. American Depository Receipts, ADRs. Sometimes you'll just see DR for depository receipt. And now we have global depository receipts. Some companies in Europe and Asia will do the same thing for companies in the United States. And that's why if you look up Nike, sometimes you'll see Nike on Mexico exchange. You'll see Nike on the German exchange or the London exchange. They've done the same thing. Now there are international brokerage accounts. Most large brokerages, offer you the ability to buy and sell shares in other currencies. You can change your dollars into yen or euros or pesos, and then you can transact on those exchanges. Now, of course, you don't know what's going on. You're just using your computer and logging into your brokerage account. But that's exactly what they're doing. They're changing your dollars you are changing your dollars to another currency, and you're keeping track of the currencies, and then you're buying and selling on the Korean exchange or whatever. Most people don't bother with this. I certainly don't. I like global and, for some people, international mutual funds. Why? Because the mutual fund company has far more resources. I don't necessarily believe you're going to get a very good exchange rate because you're not exchanging millions of dollars. You're exchanging a few $1,000s. But I don't know. I haven't done it, so I don't really know. Now, here's the question one has to ask. If you're going to go out and buy shares on another exchange in a different currency, you have to remember that not only are you dealing with the company as a company, an investment as a company, and its success or lack thereof, you'll also have to worry about the currency issues, because it's a seesaw, folks. If the dollar gets stronger, all things being the same, and of course they never are, your investments outside the United States are now worth less. Huh? Well, think about it. It makes sense. The dollar is stronger. So if you want to sell your asset outside the United States, you have to sell it in the currency. Let's do Mexico. Some of you have crossed the border often. You know this. You've experienced it. You have to sell your asset in pesos, but now it takes more pesos to buy the same number of dollars. You with me? You understand that? Of course, it makes it great for us as vacationers in Mexico because our dollars go further. But a weaker dollar, on the other hand, has a positive impact, all things being considered, and they never are. Why is that? Well, think about it. Now you get more dollars for your pesos or euros or yen or whatever. So when you sell your asset abroad, you're going to be able to exchange the currency you received, say pesos, into more dollars. So it's a bit of a seesaw. And the question you have to ask yourself is will the dollar be stronger or weaker in the coming years? The dollar has been very strong, and there's some reasons we could spend a lot of time talking about it. One of the biggest reasons the dollar has been strong is just because we're importing far less oil than we used to. We used to send hundreds of billions of dollars overseas to buy oil, but now we're not doing that. We're actually exporting a lot of oil. We're the world's largest oil producer. Most people don't believe that. You ask who the world's largest oil producer, they usually say Saudi Arabia. No, actually Russia exports more, and produces more, and we are producing the most. Yay, United States. And it has to do with fracking, which is not a very good word. I wish they would have created that word. But if you're so inclined, look up our oil production. It's pretty interesting story. Slide number 81. So those were the different types, and we want you to internalize those, memorize those. Do whatever you need to do with I like flashcards, however you want to pull it off, because we're going to ask you on the exam. But more importantly, you really need to be able to sit down and look at a stock and kind of put it in a category. Even though we said some companies fit in more than one category, some companies don't fit neatly in any category. You do the best you can. Slide 81. Now, let's talk about one of the most important statistics that gets overlooked, and that is the market capitalization. Now, we've already discussed this in Chapter 2 when we talked about large cap, mid cap, and small cap mutual funds, stock mutual funds. Well, now let's define what market capitalization is. It's actually a very simple statistic, and we don't have to calculate it, although I'm going to ask you to do that on worksheet number 3. It's the current price of the stock times the number of shares outstanding. Folks, if you don't know the number of shares outstanding, the current price is useless. And that's what everybody focuses on, right? Everybody focuses on the price. How many shares are outstanding? What is the company worth? Well, we created the 3 categories back in Chapter 2. Let's review them. Papa Bear, Mama Bear, and Baby Bear. Large cap, mid cap, small cap. You know what? They're supposed to have hyphens in between, right? As I remember. Sometimes you see them without the hyphens, sometimes you see them with the hyphens, but I think you're supposed to have the hyphens there. For many years, large cap was $10 billion and up, but now you're hearing people say or reading in the news, they really have to be at least 15 billion to be whatever. You decide which ones, the older ones or the newer ones. I still use the older ones. There's a subset of large cap called mega cap. These are companies that are in the hundreds of billions of dollars. Yeah, there are not that many, but there are more and more of them. At least there were until 2022. Mid cap or anywhere between 2 and 10 billion. Now you're hearing people say, oh no, they have to be at least $5 or $6 billion, upwards of $15 billion to be mid cap. You decide which one you want to use. Either one is fine by me. And then small cap is anywhere from about 100 million up to 2 billion, although now you're seeing mutual funds and reading people say mutual funds defining small cap and other people defining small cap is up to $5 or $6 billion. And there's a subcategory, a subset of small cap called micro cap. And these are tiny companies, to to you and I, to you and me, I'm sorry, to you and me, $50 million is a lot of money, but in the publicly traded world of companies, they're tiny, they're micro cap. So those are the ones we want you to remember. Remember large cap, mid cap, small cap, and that mega cap is a subset of large cap, upwards of hundreds of billions of dollars. And micro cap is a subset of small cap, under 100 million or so. And then there are penny stocks that aren't worth much at all, maybe tens of thousands of dollars, maybe not even that much. Folks, we've already told you to stay away from these things. They shouldn't even be discussed in polite company. And you'll hear people say they sell from less than $1 to up to $5 a share, but usually they sell for pennies. That's why they're called penny stocks, and they're scams. And you can really have your money just taken from you. And these people don't care. They don't have any conscience whatsoever. They might inhabit the White House like one of the former presidents did, who has no conscience. Anyway, slide number 82. Slide number 82. Price is $20. How much is the company worth? Well, we don't know until we know the number of shares. There are 5 million shares outstanding. The market capitalization is 100 million. This is a small cap stock, and it's verging on the micro cap, isn't it? Right. Now, the stock price, for the most part, is irrelevant until you get down to pennies. Then stay away. You must look at the market capitalization to see what the value of the company is. Remember Warren Buffett's Berkshire Hathaway? Yeah, he just said, I'm not going to split it. And so the price is $470,000 as of 2023. But if he had split the stock over the years, as other companies like Coca-Cola and McDonald's, it might be a couple $100, but there would be millions, billions more shares outstanding. So you gotta look at the market capitalization. Now in the worksheet number 3, you're going to do worksheet number 3 because it's going to be on the exam. But more importantly, at least you'll do a few calculations. You don't have to do them. After you do them on chapter 3, after you do them for the worksheet, you don't have to do them because all you do is you look it up. It's already done for you. It'll tell you on the Infernal Net or your brokerage account what the market capitalization is. So now let's take a look. Let's take a look at a couple of companies, few companies that you may have heard of. Slide 83. Walmart and Target. You've heard of these little mom and pop shops? Yes, sure you have. As of 1st of September 2023, the price of Walmart was $161.57, and the price of Target was $125.52. And just looking at the price, you might think, wait a minute. Is Target about 70% as big as Walmart? No, Target is much bigger than Walmart. Walmart is all around the world. Target tried to leave the United States, moved into Canada, and failed miserably. And you would think they would do pretty well because they're based up, I think, in Minneapolis, right, which is pretty close to Canada. Anyway, they didn't do very well. That doesn't mean they're not a profitable company. They're just not as big as Walmart. What we need to do is take a look at the number of shares outstanding. And when we do that, we see there are 2.69 billion shares of Walmart and only 461.6 million shares of Target. And what does that equate to? Target is about 1/9 the size of Walmart. Walmart is a mega cap company of over $400 billion. Target's no slouch, $57 billion, almost $58 billion, but it's still a large cap company, but it's nowhere near as big as Walmart. So this is what we want you to start thinking of as opposed to just the price of the stock. That's what everybody keys on. No, think about what the company's worth. In other words, if you wanted to buy Walmart, you'd have to have $435 billion in your pocket and walk on down to the New York stock. No, it doesn't work that way, folks. When one company wants to buy another company, whatever, you have to have about 10 to 20% more. And we talk a little bit about this in worksheet number 3. It's called a tender offer, a takeover offer, because you have to think about it. You have to think about it. I mean, if you wanted to buy all the shares of Walmart and all of a sudden somebody's out there trying to buy every share that's offered, the price is going to start going up and up and up and up, and people are going to go, what's going on here? For that reason, there's a process that you have to follow. It's a procedure where you go to the exchange and say, I would like to make a tender offer for, now no one's going to buy Walmart for over $400 billion, but let's say Target. Let's say Walmart wanted to buy Target. They wouldn't be allowed to because of antitrust rules, anti-competition rules. But let's say they had $60 billion in their pocket, and some companies do, like Apple and Google and Microsoft. And they walked on down to the New York Stock Exchange and said, we'd like to buy Target. Well, what's going to happen is there's a set methodology, and they're going to have to offer about 10 to 20% more. So in this case, if the stock price is $125, they're going to have to offer about $140, maybe $150 a share. So think about it. That's pretty important insider information, isn't it? If you knew that. So it's all hush hush. And then there's a set methodology for when these tender offers are announced to the public. If the marketplace, if the millions of investors around the world believe that it is a bona fide offer, which is a fancy word for authentic, a real offer, then the price, bingo, will zoom pretty much close to what the tender offer is. If the market doesn't believe that it's a real offer, then it might go up a little bit. If there's a belief that another company is going to try to outbid the one company, the price might go higher. So you see where there could be opportunities for hanky-panky. And this is where Elon Musk of Tesla fame got in trouble. He was goofing with his girlfriend and said they were going to offer $420 for the stock. I think the stock was about $360 or something like that. And of course, he didn't do it the right way. He didn't go to the SEC, and he just did it in a Twitter. Twitter post, X now, right? And it was a joke because 420 is the number of marijuana, right? So he got fined $20 million, and Tesla got fined $20 million. He had to wind up paying it. Yeah, folks, he needs somebody to watch over him because as brilliant as he is, he's a bit of a loose cannon. So we know that Target, although a large company, is nowhere near as big as Walmart. And the takeaway is the price is not relevant until we know the number of shares outstanding. Then we know how much the company is worth. Slide 84, AT&T and Verizon. You know these two companies, the duopoly, and T-Mobile's trying to nuzzle themselves in, and there's a few other players, but these are the two big players. And you see that the price as of September 1st, 2023 was almost a little over $14.50, $14.65 for AT&T, $34.86 for Verizon. So you might think that AT&T or Verizon was over twice as large. No. There are 7.15 billion shares of AT&T, only 4.2 billion shares of Verizon. So Verizon is larger by about a third, a little less, than AT&T, but not over twice as large. And both of these companies have, if you go look them up, folks, look at their dividend yield, which is really, really generous. But people are worried about the future for these companies. Why? Because they always have to be putting out billions of dollars to upgrade their equipment every few years when there's a new technology come out. And of course, people don't want to pay more. They want to pay what they've been paying. And everybody already has a cell phone and a service plan, so the only way they can grow is by eating each other. AT&T has made a major push into Mexico, but Mexico Telmex is pretty darn strong in that Mexican market. So, would you invest in AT&T or Verizon? Maybe check them out as a couple of the stocks you're looking for, because one of the things that we're going to emphasize, now and later on, over and over again, is that you can't just look at a company in a vacuum. You can't just look at AT&T without looking at Verizon and T-Mobile, right? You've got to look at their competitors. In fact, Peter Lynch, in the book One Up on Wall Street, which you're going to read, I hope, because books are cool, you can download it to your phone, says that some of his best ideas for companies came from looking at the competitors of the company that he was investigating. Very cool. And our last example, so that was it. One time, my apologies. I thought we had another example. So that was our discussion of types of companies and market capitalization. So now it's time to do worksheet number 3. Make sure you do worksheet number 3 and review those types. We're going to want you to memorize those, burn those into the back of your eyelids, so that if you look at a company, you say, "Oh, this might be an asset play, or this is a blue chip company, or this is a cyclical company." Okay, and don't worry about getting it right or wrong. It takes practice. It's a process. And as we said, some companies don't fit into any categories. So we hope you are enjoying the education. We hope you are learning. Think about how much you've learned. We're ready finally for our very last presentation of Chapter 3. And this is where we'll take a look at investment strategies, throwing all the knowledge we've come to we've come across and reviewed into the different types of strategies that we'll use to go ahead and invest in stocks. Okay? Be awesome, dear students. We're proud of you. Don't give up. Never give up. Study every day. You are rising investment gurus.